Best Sense Market Commentary for the first week of November 2025. And a pretty quiet week last week towards the end, but then the last couple of trading sessions a bit weak, especially in the US, and down a couple of percent for most markets. But Japan, where we've noticed it's been very driven by liquidity, and this is perhaps another instance where it's a bit of a lightning rod for sentiment. So down 4% just overnight. And you can see in the US as well, we've been watching quite closely some of these areas of the market that we think have been sort of quite fizzy and also being affected by these liquidity flows, which we think are very influential at the moment. Market structure seems to be something that you need to keep an eye on. And you can see here in this chart, European small caps sort of following the same trend, but intraday not really moving very much, up a couple of percent, down again. But it's the Russell 2000, not only twice the moves day to day, but it's within the days. A lot of volatility there. So just something to keep an eye on. But on the other hand, this is probably just the beginning of or just part of a healthy correction when we look at the fact that markets are up for a diversified 70-30 portfolio for an Australian investor, almost about 10%. And that just sort of takes it down to about 9% or something like that. And most markets up, around 20% with Australia lagging. We'll get into that in a little bit more detail and some of the things that seem to be afflicting the local market. But something else just to note in that chart, that year-to-date chart, when we look at the oscillations of inflation, we've seen yields in the US and in Australia, which follow the US, especially at the long end, quite closely, tick up quite markedly in the last couple of weeks. Now, we spoke about last week a relatively benign inflation print in the US, but in Australia we had a more recent one where you squint very closely, you can see that green line just edging up towards that sort of 1% per quarter, 4% per annum, which is one of the things that the RBA spoke about yesterday, a little bit worried about. A lot of that's energy and housing, and it might just be noise, but that US print might also just be noise because there's been a lot of polemic in the US as well about cost of living pressures, and below the surface, consumers seem to be feeling that. But in Australia, obviously, it's house prices that are more of a concern, and probably the takeaway for advisors, clients, is in the last week, we've probably seen about a one rate cut, 25 basis points taken off the table until next year. And that's across the curve. But obviously in Australia, the short-term rate implication is one of the more important things. And interestingly, we had Andrew Hunt's Australia review come in overnight. And we've been having a bit of a look at that. We'll probably talk in more detail with him next week about that. But the striking comment that he made, and this kind of resonates, he said Australia's economy is relatively difficult to analyse. And he talks about, quite strong domestic demand. Maybe those cuts in interest rates and the sort of feel-good effect of rising house prices has helped out there. But on a look-through basis, everything's a little bit muddled through and difficult to interpret. Productivity has been very weak, but maybe slightly increasing. Job participation's been increasing, but the amount of work we get done per hour is actually still pretty stagnant. And terms of trade just kind of muddling along. And that's the thing that really seems to drive Australia. Unfortunately, maybe there's something else we've got to think about. And we'll talk about that with Andrew later on. In the US, consumer confidence is obviously something that's, been on the ebb. It's not at rock bottom lows. But again, there's this feeling of things being polarized. There's certain parts of America doing very well, driven by, for instance, CapEx on AI infrastructure. But there's a large part of the population who are feeling the pinch a little bit, worried about jobs. There's less job creation and also higher costs. And ironically, some of that is coming through energy costs, especially where that power is needed. But on the other hand, the US earnings season, with 70% of companies having reported, has been very strong, 10% year on year for earnings. But as you can see from that chart, and we've shown you a few different versions of that over the last few weeks, it stayed pretty consistent, except we've now seen, as we get into the sort of bulk of the industrial companies that reported a lot more last week, you can see that certainly in terms of earnings, actually pretty stagnant. And some of those year on year, especially for communication services, energy, and also healthcare, year on year, actually in the negative. being completely made up for by the banks and the more tech-heavy sectors. So again, polarization, a word that keeps on coming up and something that we're seeing in corporate America and across the population as well. So overall, a bit of a muddle through week, and we'll keep an eye on some of the shortest term stuff that's happening. But there's this overall sense that there's probably going to be a little bit of a pinch at some point, and it'll be interesting to see what the powers that be in the US do. And if they stimulate a lot, well, maybe it's off to the races again, or maybe there's a little bit of volatility before that happens. And maybe next week we'll talk to Andrew Hunt to get his latest gauge on what's happening in Australia and elsewhere. Talk to you then. Thanks.